Hey guys, it's Doc's Market Minute for Thursday, February 25th. What I've got here is the risk profile of what's called a broken wing butterfly. So what we do is we take a normal looking butterfly and we mutate this thing. Normal looking butterfly is a debit spread with a nice profit peak at expiration, and then it goes back down on the other side to a controlled limited risk trade. Okay, so far so good. The only problem is it's a debit. And so what we want to do with bear markets is we want to create income trades where if we're wrong or if the market falls to pieces down here, no risk to the downside. I keep the credit. Now, I'm not going to retire based on the trades that are doing that. I mean, we get a very small credit for these trades. But again, the point here is that there's no risk to the downside, which is a very, very good thing. So what we're going to have during bear markets and corrective price action is we're going to have price action that, falls to pieces, and then once it bottoms out, we're going to get some strong rallies coming up here. Okay, so what I want to do is I want to center this profit peak around where I believe resistance to be. In this case right now it's about the 195 level. So I think resistance is going to hold at the 195 level, and it will hold until it doesn't anymore. What will happen at some point is maybe that 195 level will get run through, retested, and then it's off to the races. This is pretty common with overhead resistance. So here I am with this trade. Now this only has just about a week left to go. You can see the green line is the expiration graph, and that's a very nice graph. However, we have to earn it, don't we? The T+0 line, this is the white line, this is the realized profit and loss right now, and it's getting close to falling over the edge here and getting into negative territory. So what do we do about that? Well, there's a lot of different things that we can do about that. First of all, the best thing that could happen is nothing happens to the price, and it's simply as we burn off time value into next week, we're able to close this trade down for a decent profit. Not a great profit, but we could get a great profit if it continues just to go nowhere underneath the 195 level. So what happens if it doesn't? What happens if we start to see movement above the 195 level? And it could go really fast too, because undoubtedly there's people either holding short positions above there, or perhaps there's going to be some type of short covering occurring if we get above 195. So I have to be prepared to do something about this, because what I don't want to do is just stick my head in the sand, and if the price goes up here to 198 or 199 by next week, say, oh darn, there's not much I can do about that. So that brings up something else that I usually talk about with option trading, and there is no such thing as one of these take a bad trade and turn it into a good trade things. For you to do that, if I'm up here, let's say the price decides to rally like crazy, right? And we finish up here at, something like, it goes all the way up to 200 by next week. There's really not much that I can do without adding a tremendous amount of risk to be able to rescue that trade and make a profit from it if the price decides to go berserk to the upside. So could I put a bull put spread on for next week with 100 contracts down here and recoup some of this loss? Absolutely. But man, think about the risk that I'd be adding to do something like that. What about buying just a ton of call options as the price goes higher from here? Again, that could work if the price keeps on going, but what if it turns around and goes down? So as you can see, when it comes to adjusting positions, there's no perfect way to do this. There's no way to do something like this where you're transferring risk from one position onto another without adding additional risk. So one of the first things I always say is, if we're looking at a position like this, is there a way for me to close down the position if we get into next week and make a profit on it if the price starts to go above levels that I don't want to see it go? So in other words, if it starts to creep above 195, is there a way that I can get out of the trade still with a profit? Now, chances are I'm going to have to wait till next week for that to occur. But if we start to see movement before that point, what can I do? Well, this is where we can start to be intelligent about transferring risk. What I could do is take some of this credit that we received to the downside And I can make the decision to say, look, I am willing to give up that unlimited downside, no risk characteristic of this trade, which is what it is right now. There's no risk to the downside. I'd be willing to give up some of that in order to make some type of compromise. So in other words, if the price gets up to say like 195 or so early next week, then I'm willing to make a compromise, and I would add something perhaps like a slightly out of the money calendar spread by adding it centered around the 197. So what I've done is I've extended the profitable range of this trade quite a bit, and I've also flattened the risk curve to the upside quite a bit as well too. Now I've done that at a cost of I no longer have zero risk to the downside. So if the market crashes after I add this hedge, then yeah, I'm going to be on tap for a little bit of risk to the downside. But as you can see, it's not unlimited risk. Everything that we do is always centered around adding and controlling risk in a very limited fashion. So beyond the actual techniques, I'm not going to get into the actual techniques of doing this. This would take a little bit longer. But what's more important than that is actually coming up with a plan ahead of time. Probably the most difficult thing to do in trading is not to have a plan for something and then have to figure it out on the fly. There's some examples of this that we've had over the last few years where all of a sudden the price will just start moving out of nowhere and the trapdoor opens up and all of a sudden we drop 100 points in the course of a day. If you want to look for an example of that, go back to 2010, May 6th of 2010. I watched the whole thing unfurl right in front of my eyes, and you had to have a plan. There was no way that you could trade that just sort of from the hip and figure it out on the fly, because that's where the emotions kick in. So I've got this down to pretty much just, hey, if X happens, this is what I'm going to do. If Y happens, this is what I'm going to do. And if Z happens, this is the third alternative that I can take for this trade. So I pretty much got it mapped out. Now, of course, the price can just crash from this level. If I have my original position, the price can just crash from here. And then that kind of takes away my decision points and says, well, you're getting your credit for this trade. So the position will just expire out of the money and all the options will expire, and I'll keep the original credit that I got when I set up the trade. But if the price starts to rise and it starts to go beyond the levels that I've designed early on in here, I know precisely what I'm going to do. This is what trading really comes down to, is actually programming yourself in terms of what you're going to do. And this sort of reinforces the statement that I say all the time, is that you're not really trading against the market. You're trading versus yourself. And this is another example of that, that if you can overcome these emotions, and the way that you overcome your emotions is by pre-programming yourself, telling yourself precisely what you're going to do based on what happens with the price or any other metric that you want to design your trades around. Okay, does that make sense? Hopefully that helps. Thanks for listening. We'll see you tomorrow.